India's economy returned to 8% growth for the first time in 2 years, supported by what was a positive base effect. However, economic conditions have also steadily improved as the impact of demonetization and GST have started to fade. Ira is standing by with the fine print of the first quarter growth data. Ira.
All right, I think a lot of attention has gone into the 8.2% number that we got, and absolutely justified. We have not seen these kind of growth numbers for a while. I know the skeptics said it was base effect, but you know what, guys, it wasn't entirely base effect. So let's give the economy its due credit. What you got was 8.2% on GDP, 8% on GVA. Yes, there was a base effect built in, but remember, all economists had already accounted for that. And despite that, the Bloomberg consensus number was at 7.7. Within that bucket of economists, there were people like Shugata Bhattacharya of Axis Bank who had predicted 8.2%, Shubhda Rao of Yes Bank who had predicted 8%. So, there were people who were building in some inherent economic strength, adding to that base effect, and that's exactly what happened. Now, everybody's had 2 days to look at the data, and people are slicing and dicing it various different ways. We'll give you one interpretation and then, perhaps allude to some of the other ones as well. If you just look at the very broad agriculture, industry, services breakup to see where the strength is coming in from, you've got a sense that this time around pretty much everything played along. So agriculture at 5.3 was stronger than what people were expecting. There was an uncertainty about how the agricultural number will shape up. There always is, but at 5.3% on a 3% base, agriculture played along well. You had industry at 10.3, but yes, there was a very strong base effect because you'd seen no growth in industry in the same quarter last year. And then, of course, services played along as well. In fact, some people have chosen to focus on the services number because the 7.3% services growth came actually on a very high base. So you had strong growth in services, which has also been indicated by the PMI numbers, and then you had industry play along. Just stay with this chart for a minute because, I just want to briefly tell you that within the industry segment, you had the employment generating sectors, construction do very well. So, there is that element to it as well. And then those who sliced and diced it up in a way to look at government-led growth and private-led growth also came away with the impression that the private sector has started to play a role, and the core GVA has improved from 7.2 to 8.1%. So no matter which way you slice and dice it, this number was certainly good. If you look at the expenditure side, again, you'll find very little to complain about, except the fact that perhaps consumption is growing a little too fast. And that may be something to worry about in the future quarters. But gross fixed capital formation at 10% growth continued its run, showing that there is a modest investment cycle in play. It may not be the power capex, it may not be the steel capex, but it is capex nevertheless. Private consumption, 8.5% growth. Now that's a number you want to focus on, but you want to take a little bit, sort of focus on that also from the risks point of view, which we'll come to in a minute. Government consumption at 7.5 slowed, but that's okay because, we don't want the economy too reliant on government consumption, which then brings us to what the rest of the year will look like. This number will probably bring some upside risks to the 7.4% FY19 GDP growth target that the RBI has put in. So people are now talking about a number around 7.5 and perhaps, some saying the bullish one saying closer to 8%. But Q1 GDP will be a high. The base effect will start to wear out. So Q2, Q3, Q4 will not look as buoyant as Q1 did. Keep that in mind. But also, if high growth continues, then you have a risk of a third interest rate hike coming in very much, not just on account of the currency factors, etc., but just on the underlying growth inflation risks. The MPC may be, thinking a little bit more of a third hike, given the kind of growth rates that we've seen. But of course, as everyone has pointed out, the big risks to the economy continue to be current account deficit and the external risks. On the current account deficit, in some ways, it links back to that very strong consumption number that we got, because that consumption number is feeding into strong demand for consumer items, iPhones, etc., 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 and that is adding to the current account deficit risk, along with, of course, oil, which remains the biggest wild card and the biggest factor that we have to watch.
Interesting that, Tira. Thanks for that, putting that in perspective.